Good morning, everyone. Again, my name is Joe Bonelli. I'm an associate extension educator here at the University Department of Extension, University of Connecticut. I would like to welcome you to today's webinar put on by Chris Laughton from Farm Credit East. This is a series of webinars on a number of topics, and all of our materials, including our videos, video clips, and materials, are available on our website as well too. Mackenzie will be sending out that website link to all of the participants. I would like also to thank Mackenzie White, a colleague of mine at UConn Extension, for handling the technology today regarding this webinar and a series of webinars as well too. So thank you, Mackenzie, for doing that. I'd like to introduce Chris Laughton, today's presenter. Chris Laughton is the Director of Knowledge Exchange at Farm Credit East. In his role there, he is responsible for research and analysis of Northeast agriculture. He writes frequently about the junction between agricultural production, economics, and policy. He also conducts outreach to the diverse agricultural communities of the region and oversees Farm Credit East customer education programs, including webinars and live events. He holds a bachelor's degree in horticulture from Cornell University, an MBA from UMass, and recently received a Master of Science in Applied and Research Economics from the University of Connecticut. Chris grew up in Eastern Massachusetts, where he worked in his family's greenhouse nursery business before joining Farm Credit East. Also, this program is supported by a grant from USDA NEFA and through the Northeast Risk Management Education Program. Without further ado, I'll introduce Chris Laughton. Chris?
Thanks, Joe. Thanks, Mackenzie. Can you see and hear me okay? Just want to check before I begin.
Yep, looks good.
Great.
Looks good.
So I will take it away. So in my time today, we're going to talk about benchmarking and benchmarking for farm success. So I'm going to first cover the concept of benchmarking and explain, what it is to begin with. Talk a little bit about why it makes sense to use benchmarks in farm management and how they can help you improve your operations and your profitability. I'm going to spend a fair amount of time covering where to find the data and how to use it. And then at the end, we're going to touch briefly on what to consider as next steps. So to begin, what is benchmarking anyway? You've probably heard of it, but a lot of people are not real clear on what it means exactly. And basically, benchmarking is simply the process of comparing your business metrics against some kind of standard. It can be against your own business over time, so you don't necessarily need to have outside data if you want to benchmark. And I think in many ways, the most valuable benchmarking is against yourself. But we think more often about benchmarking against other businesses in your industry and area, your peers. You can also benchmark against other businesses that are different, a different region or sector, another sector of agriculture or another part of the country, or even another business or another investment, perhaps completely outside of agriculture. Benchmarking basically is the search for industry best practices for superior performance. And ultimately, it's an extension of financial statement analysis. Some of the best ways to manage a business is by running the numbers and looking at your numbers and your statements. And benchmarking can be an extension of analyzing those financial statements and those metrics. So why should you consider benchmarking? A big reason is to learn more about your own business. And fully, in my opinion, at least half the value of benchmarking at all is that it forces you really to get your financial statements, your chart of accounts, the way you track your business into a kind of a standard format, and to really examine how you're putting your financial statements and your information together. And it kind of forces you to do a better job of that. And I think that in and of itself is half the value. But beyond that, it's to see how you measure up against others and against yourself. Benchmarking can enable you to find areas where you're doing well and where you're not. We benchmark because we don't know everything. And there's that statement that, there's the known unknowns, there's the things that you don't know. And then there's you don't know what you don't know. There's things that you may find in the benchmarking process that, I didn't really realize that this particular part of my business could be its own profit center, or, I didn't realize how far off I was on this expense, or that sort of thing. Benchmarking can help you improve your efficiency and your effectiveness in your business. It can help you track progress of goals. And ultimately, benchmarking can help you be the best business you can be. And it doesn't need to be strictly about profit. Many people go into agriculture for a number of reasons, some of which are non-financial reasons. So benchmarks don't have to be just dollars and cents. They can be things like the time you put into your business. Are you killing yourself and putting in crazy hours and other people are not? Or it could be a number of non-financial goals. It could be certain ways of farming, certain practices that are important to you, that kind of thing. So benchmarks don't have to just be dollars and cents. They can be, you can benchmark operational goals as well. So as I said, types of benchmarking, there's internal, there's tracking your performance, typically year over year. Many agricultural businesses are seasonal. So you'd look at tracking your business month over, the equivalent month, year over year, this year's May to last year's May, or many people will even go week by week. And you can track that operationally and financially. You can also track the performance of different business units. Many Northeast agricultural businesses are diverse. Just to throw one example out there, you may be a vegetable farm with a retail farm stand. You can track the performance of your retail farm stand operation and your performance of your vegetable growing enterprise, and see how the two compare against each other. That can be relevant if you're trying to make investment decisions and look at, where should I put my money, given that it's usually limited, you can't do everything you want, and where does it make most sense to invest in my business? You can also benchmark externally. You can look at your performance, quantitative and qualitative measures of yourself versus your peers and competitors. You can look at numbers, and you can also look at qualitative measures like operational things. You can consider the experience of your retail store compared to the retail store of a competitor. How does it look and feel? And are you keeping pace with the Joneses, so to speak, in terms of retail? The retail experience. Your customers are probably shopping at more than one place, so they're seeing the difference between you and your competitors. It's important for you to consider that as well. So as I said, you can look at financial numbers, how your numbers look versus others, and then operational, how efficient is your business? How effective are you at running your business? So as I said, start with yourself first. A lot of times when we talk about benchmarking, people immediately sort of gravitate towards finding external data and, looking at those numbers compared to their own financial statements. And that's a little bit of jumping the gun. You want to make sure first that your records are good. You want to make sure that your records are consistent. Don't make major changes in things like how you account for inventory or depreciation from one year to the next. That makes it hard to make comparisons. So you want to have some consistency in your records and how you account for things. Don't get overwhelmed. You can overwhelm yourself with information and have that kind of paralysis by analysis, they sometimes say. Pick a couple of spots and work on them and strive for improvement, and then set goals and follow through. If let's say your sales per employee are not quite as robust as what your competitors might be, decide, okay, I'm going to improve that by 10% over the next year. And then, look at that, track it, see if you achieve that goal, and then either strive to do better or figure out, why wasn't I able to reach that? The next is look at others. Consider your competition and define it broadly. If you're a retail garden center, your competition is other retail garden centers for sure, but more broadly, it may be other recreational opportunities, other types of farms, other other farm stands in the area, other places where people go and spend money in their home. So look at other businesses in your area and where your customers might be spending money. Look at what they do well. Oftentimes, some of the best. I used to run a retail garden center, and some of my best ideas often came not from other garden centers, but from other retailers. I would look at, what are other retailers doing well outside my industry, and how can I adapt this to the garden center industry? Consider what your competitors' strengths and weaknesses are, and how do you compare? Consider your customers' decision points to the extent that you can find out what they are, and if you don't know, ask them. And how you perform versus others. Are your customers price driven primarily? Some of them probably are. Some of them may not be. Are they looking for the experience of shopping with you? Are they buying the story? If you're a vegetable grower, are you producing in a certain way? Are you do you have a CSA? Are you organic? Are you telling the story about your family farm and how you choose to grow your crops? What is kind of driving the customer to come to you? And how well are you doing at those things that your customers really value? Continuing looking at others, examine the numbers, hold yourself and your team accountable. It's a good idea to involve other people on your team. Oftentimes, business owners and small businesses like to keep things close to the vest and not share everything with their employees, and that can make sense in some ways. But ultimately, management and more specifically, leadership is really about getting a team to work together to achieve shared goals. So it's really a great thing if your team, you and your employees can work together to achieve goals that you both share. So it's good if you can communicate with your staff and say, we need to, we have good customer traffic in our store, but our average sales per transaction are very low. And I've looked at our peers and we're low in that, and we could do better. So we need to look at upselling. We need to look at, what our customers are buying, maybe re-merchandise our store, and think about how you can work together and be part of it. Because ultimately, as a business owner, unless you're very small, you're not usually the main point of contact between your business and its customers. So it's important that your team know what you want to accomplish and buy into it. So strive to be a leader, and strive to be a leader not just in your operation, but in your industry as well. Continuing the comparison to your others, if you're using an external benchmark, be sure that your accounting standards match your comparison numbers, however they're doing them. So don't just grab a chart of accounts from a benchmark that you found somewhere online without considering, okay, how did they get to these numbers? If you're looking at things like a balance sheet, is that book value versus actual value? If you're looking at things like, assets, are they considering the value of real estate at its acquisition cost, which is typically book value, or are they looking at that value at actual current value? It's not always applicable, that book value versus actual value, in every benchmark scenario, but basically you want to make sure particularly that you're accounting for things like inventory the same way. The picture I have in my slide here is a winery. How are they accounting for the value of that wine? Are they considering the value of it if it was bottled and sold at retail? Are they valuing it at the cost that it costs to put that grape juice in the barrel? Are they sort of valuating the work in progress value of that inventory? Any of those methods probably would be acceptable. You want to make sure you're comparing the same things. It's most important in inventory heavy industries like something like a winery, an agricultural sector that has stored crops, a nursery is particularly important. Um, changes in how you account for inventory or differences between them, the benchmark can really skew the numbers quite a bit. Another big one is depreciation. Is depreciation included in the income statement you're looking at in yours and in the benchmark one? Um, including or excluding depreciation and how you calculate that can make a big difference. You probably don't want to use your tax return statements for benchmarking, whether it's for yourself or against others, because your tax returns are not really management documents. They're designed to minimize your tax liability, right? So oftentimes in depreciation, you may have some kind of accelerated depreciation scheme, Section 179, some kind of accelerated write-off of equipment purchases. It's not really reality. You should have a separate set of management financials that you're looking at. Owner draws, how are you accounting for those? Are you on the payroll as an owner and accounting for your salary in part of hired labor? Or do you have a sole proprietorship model where you're taking an owner draw out of the profits at the end of the day? Again, either of those scenarios are acceptable, but you want to make sure that what you're doing is consistent with what you're comparing to. Your business may look, if you're comparing against the benchmark where the owner draw is embedded in labor and you're taking it out of profits, your business may look very profitable compared to one where the owner draw, if it's significant, is coming out of labor. So, you want to make sure that you're matching whatever your comparison is. So moving on to where to get the benchmark data. I talked about that perhaps the most important data comes from yourself, and really standardizing, formalizing, being consistent about how you do your own accounting is important. But at some point, you're probably going to want to look at external data and how your business compares to others. So getting benchmark data can be a little bit tricky. It varies substantially by industry sector. Universities and extension services can be a good source, not just UConn, which is great, of course, but other extension services around the country. There are some paid industry programs that can be quite valuable. Sometimes trade associations or peer groups can be useful. Sometimes the more niche the sector, the harder it is to find good benchmark data. So that can be a factor. Certainly it affects sample sizes. So that's something to consider if you get a benchmark from somebody. How many farms does this represent? Is it 5 farms or is it 100 farms? Diverse operations in particular present a challenge. Ultimately, benchmarks are best if they're apples to apples comparisons. If you're a diverse operation, if you have an apple orchard, pick your own farm stand, wholesale cider, corn maze, whatever, and you just produce consolidated financials, that's going to really be hard to benchmark, whether it's to yourself or to others, because you don't really know what's driving your profits and losses. You might be killing it on your corn maze and losing money on your farm stand, or vice versa. So enterprising your operations is really a useful and worthwhile exercise. And that way you can, if you enterprise your operations and kind of break them out by the type of business they represent, then you can benchmark those against others. Going back to that orchard, how does that orchard compare as an orchard, in terms of just growing fruit? How does your farm stand compare as a retail farm stand? How does that, I don't know if there's a corn maze benchmark out there, I'm not sure, but how does that compare as an agritourism attraction? So those are things to consider. One thing to consider, a note on paid programs or paying for benchmark information from sources. In the ag sector, different than other industries really, we're all a bit spoiled because of organizations like Extension that provide excellent resources and information, usually for free. But it's worth paying sometimes. I've seen farms spend thousands and thousands of dollars without batting an eyelash on a piece of equipment, but agonize over spending a couple $1,000s on a benchmark service or a management consulting or something like that. And really, consider that the decisions we make in business can only be as good as the information that we base them on. So if you change one thing for the better as a result of some information that you acquire, then you've paid off your investment, really. So, I'm not trying to sell you on anything or tell you to go out and blow a lot of money on something, but, consider that it's sometimes worth making an investment in something like this because it ultimately helps you make better management decisions. And that's where that's going to be a big influence on your profitability. So, given that I work for Farm Credit East, I would be remiss if I didn't mention our Success Strategies benchmark programs. We have them for ag retail, which is like garden centers and farm stands, whether it's ornamentals or food. But ag selling direct to consumer. We have them for dairy farms and for wineries. These are paid programs. You join, you pay a fee, you become part of a peer group, and they really do a deep dive into both financial as well as operational metrics and look at how you compare to peers in the group. And they can be very valuable. Other resources, free resources, for dairy are the Farm Credit East Northeast Dairy Farm Summary. The Dairy Farm Summary is produced every year. I'm working on the 2020 now. That's, comes out in 2021, but it's the 2020 financial data. That'll be out in about a month. And from that, we can produce what we call My Farm reports, which will compare your farm's financials to the benchmark. And you can compare yourself to farms of the same size, farms that are in different profit quartiles. So you can look at, top profit farms versus yourself. You can look at farms over a period of years. And so that can be useful. Cornell has its own dairy farm business summary. It's New York focused, as you might imagine, Cornell being located, of course, in New York. But that doesn't mean it's not worth considering and comparing yourself to it. You don't have to be a New York farm to get the data. So you can get their dairy farm business summary by, just Google searching Cornell Dairy Farm Business Summary, and it'll come up. And that's another free resource and worth looking at. Farm Credit East offers other data. We have limited benchmarks available for greenhouses, wholesale greenhouses, what we call cash field crops, row crops, things like corn, soybeans, hay, logging, nursery crops, orchard fruit, mixed vegetables. We're in a bit of a transition at this point. We're working on a new generation of benchmarks. So we have existing data through 2017, so it's a little bit old, but your benchmark that you're using doesn't have to be completely current. You can look at, compare your 2017 financials to the 2017 financials of a benchmark, or whatever year is available, or compare your current year against that year. You just want to factor in, if you're looking at different years, consider a couple of things. If you're in a commodity business, consider, what were commodity prices? Like, for example, in dairy, if you're comparing, this year versus 2014, which was a peak price year, the financials are obviously going to be different. So you want to take that into account. If you're in, say, an ag retail industry or a garden center business, you'll want to consider the weather. If Mother's Day was rained out one year, and you compare it to another year when Mother's Day was beautiful and sunny, it wouldn't be surprising if you beat the pants off of the sales you had during the rainy year. So when I was in the garden center business, my father used to have a diary that he kept. Benchmarking doesn't need to be super technical or complicated. It was just a, pen and pencil diary. But he wrote down things like, every weekend, what the sales were, what the weather was like, was it a washout or was it a great day? Um, Notable events of the weekend, um, think occurrences, crop data, how did the things look like in the greenhouse? Anything that might affect the business, and he would compare that from year to year. Every year he would go back to the, prior year's diaries and look at what he wrote in the year or two prior to that and see, how did things compare? How did we do compared to last year? I might think I did great this weekend and then find out last year, geez, I'm actually down from last year. What changed? What happened? So again, it doesn't need to be super complicated or technical. It's just, making comparisons. So now we'll look at some other external services. If you're in the row crops or livestock business, a good resource for benchmarks is what's called FinBin. It's produced by the University of Minnesota. It is Midwest focused, but it has some Northeast data. Pennsylvania is in there on quite a few of their benchmarks. It's good for major crops or livestock. They do have other sectors in there. They have some information on vegetables. They have some on fruit. But their strong point is those row crops and livestock. It does take some playing around. There's a lot of options you can sort. And you may have to try, 5 or 6 different scenarios before you get a benchmark that makes sense for you to compare yourself to. But there are URLs on the screen there. And I should mention that this webinar is going to be recorded and accessible on UConn Extension's webpage. And I'm sure that Mackenzie at the end of our session today can give you the link to that. So don't feel that you need to write everything down real fast. You'll be able to access this later, but FinBin can be a way to access some benchmark data for some of those sectors. Another one for ag, retail, and garden center is, of course, the Farm Credit East Ag Retail Benchmark, which I mentioned, but there are other external programs, and these are paid, but there is one group called the Garden Center Group that is a peer group of top garden centers around the U.S. That are frankly leaders in the industry. And if you join the Garden Center Group, you can compare yourself to their performance and share best practices and best ideas and things like that. John Kennedy may be someone that's familiar to you. He's one of the main consultants that is involved with this group. Just Google searching that name or the Garden Center Group will pull them up. Another one is Ian Baldwin. He's an industry, known throughout the industry, and he's a really good resource for benchmarking or best practices in the garden center space. For vegetables, a good source for data is an organization called CISA. Stands for Community Involved in Sustaining Agriculture. They're located in Western Mass, I believe, and they're New England focused. There's their URL there on the screen, and they're, I believe, in the process of developing financial benchmarks for Northeast vegetable farmers. And if you contact them, you can, I believe, get in on that process and include your farm in the benchmarking process. Another one for vegetables is the University of New Hampshire Extension. This is a current current project in development that is seeking participants. Mike Cibarassi is the leader of that, and I put his email up on the screen. I talked with him last week, and he encouraged me to share his contact information and said that if you're a vegetable grower interested in benchmarking, to feel free to reach out to him. Their URL is also on the screen, and you may be able to include yourself in their benchmarking process or get their data to make comparisons against your own farm when that becomes available. Another one, I'm getting into some niche industries here, but beekeeping. Cornell has a great beekeeping benchmark. I believe the most recent data year is 2017, but as I said, as long as you consider apples to apples year comparisons, or look at current data against 2017, but just consider if, weather or economic factors may be different. But anyway, their URL for their beekeeping benchmark is on the screen. Maple, University of Vermont has a Maple benchmark program, which you can consider getting information on. Other sources, there's an organization called the Risk Management Association. It's not ag specific. It's primarily an organization of bankers, and it gets its name because banks try to manage their risk, risk of loans going bad, or, that sort of thing. And so they have a program called Statement Studies, which is available by what they call NAICS codes, NAICS codes. That stands for North American Standard Inventory, Standard Industry Classification, or something like that, but it's NAICS. And you can get a statement study or a benchmark for something like 180 different NAICS codes, and it includes a bunch of agriculture ones. So you can go in there and look at, orchard fruit, or mixed vegetables, or, you name it, row crops, whatever. And it costs $160, which is pretty reasonable. You can get a benchmark of any single industry sector. So you can go onto that website that I have listed on the URL here. Make some clicks through and select your industry sector, pay $160 and get a benchmark, a current benchmark for your industry, which you can then compare yourself to. They're national, so they're not regionally specific, but can give you some useful information. Another one is you don't necessarily need to find a existing data source. You can find peers or mentors with similar business models, but who you don't compete directly with, to compare notes. Again, going back to my own personal experience, I was in the greenhouse and garden center business, and my father had a really good friend that had a similar business that was about 2 hours away by car. So we weren't really in the same marketplace, but they became good friends, and they often got together and opened the books with each other, or even just called each other after a busy spring weekend and say, hey, how'd things go for you? Or compare notes, or even good ideas that they had, or whatever. And that was extremely valuable to my father. If he was struggling with something, or even if something was going really well, he was able to call up his friend and in the industry, and they also met, a couple times a year and went over numbers. And that was very good, and it was very informal. It didn't really cost for anything, and that was very useful to him. Another thing is, if you just go on, a search engine and type in your industry and benchmark and see what comes up, you may find some useful information. It may take a little bit of digging, but it's worth spending a little bit of time finding some of that. And don't be discouraged if you don't find the exact thing you're looking for. Even a benchmark in a different but somewhat similar industry or another sector can still be useful to you. So how to use this data when you've got it. As I've mentioned several times, be sure you're making appropriate comparisons, comparing the same things. Make sure that you're accounting for things like inventory, depreciation, owner draw. Those are the big three, the same way as it's being accounted for in your benchmark comparison. You can look at line items, expenses, if they're available. Not every benchmark has that level of detail, but also look at things like key financial metrics and ratios. And I'll go through some of them in a minute. But those are really good, and you can use that to compare both across sizes of businesses. So you may find that when you're looking at a benchmark that, you may be, your annual gross volume might be $200,000, and the average in the benchmark is 5 million. Obviously, there's going to be some pretty significant differences in how that benchmark compares to you. But things like key financial metrics and ratios cut across um, cut across sizes of businesses, and you can compare them, as they are. You can also compare across industries or even, um, across other investments. You can look at return on equity and consider, what's the return on equity for my business that I have substantial equity tied up in, both financial equity as well as sweat equity. And, what would my return on equity be if I made an investment in just real estate or in the stock market? Am I beating it or am I not? Um, that doesn't mean you have to follow the highest ROE. There's other reasons to do what you're doing, but it's something that you might want to consider. And don't get overwhelmed. Pick a couple of things to work on and move from there. So I'm going to give a case study. This is dairy, but it doesn't, your industry doesn't have to be dairy. I'm just using that as an example because it's one of the industry sectors that the most information is available on. Some industries, particularly agricultural retail, are much harder to get good information on, but dairy is one that you can get good info. And so I'll break down, how you might use a benchmark. So the Dairy Farm Summary that we publish breaks down dairy financials by profit quartile. And compare you can compare your farm against the top quartile to see where there's opportunity, see where you might be leaving money on the table. You don't want your farm to be average. You want your farm to be a leader, to be a top performer. So you can look at look at the financial statements in the Dairy Farm Summary, and just one set of tables in the back of the book show earnings by bottom, third, second, and top profit groups. So this is kind of an abbreviated section of this financial statement of the earnings worksheet. I blew it up so you could actually see the print. It's kind of small if I did it as is, but here we have a benchmark. There's 67 farms in it, so it's a pretty good sample. Their average number of cows is almost 700, so that's something to consider. If you're a 100 cow farm, your financials are, understandably going to be different. But then it breaks it down by dollars per cow. So, to cut across sizes, if you look at just the raw dollars, obviously that 700 cow farm is going to be a lot bigger dollars than yours. But if you look at, the numbers per cow, per animal unit, we can see, okay, what did they get in 2019 in terms of milk sales per cow, per milking cow? What did they get for cattle sales? What did they get for, you know, other revenue sources? Excuse me, jumping around here. Then we have line item expenses. We have, what are they spending on farm chemicals? What are they spending on custom work? Purchased feed is often a dairy's largest expense. So what are they spending per animal unit on purchased feed? How does that compare to what you're spending? Are you high? Are you low? And if you are high or low, is that an issue? Maybe it's okay. But if you're spending 1900 and the average and the top performer quartile is 1635, maybe there's a reason that you should consider for that. And it's also interesting too that the top performer isn't necessarily the one that spent the least. If we look here, the third profit quartile, which didn't perform well financially, spent $100 less roughly on feed per animal than the top one did. So, maybe tightening your belts on some expenses doesn't make financial sense for the profitability of your farm. Sometimes you got to spend to make. So, this line item comparison can really give you a lot of good information. The Dairy Farm Summary also includes evaluation factors, what we call evaluation factors. So it looks at, how many cows per worker does the top performing farms have, and how does that compare to you? How much milk are they producing per worker? What's their milk price that they're receiving? How many crop acres do they have? What's their feed cost per hundredweight, which is how they measure wholesale milk? So, again, this is a dairy example. Your industry may be different, but just an example of how you can use operational metrics and compare your own business against those in a benchmark. So now I'm going to cover some financial metrics that businesses of all types can use to compare their own business, again, against themselves over time or against other businesses, in the same industry or other industries. So a big one is what we call term debt coverage ratio. Now that's a mouthful, but what that basically means is how much money are you making? How much money is available relative to what your debt service is? How comfortable are you making your payments to your bank? So it looks at basically it wants to find out what cash is available each year versus what your debt service is. So in this case, we have net farm income of 86,000. We're going to add back depreciation expense because that's not a cash expense. That's a non-cash line item. We're going to add back interest because that's part of debt service, so we don't want to count it twice. And then in this example, owner draw is taken out of profits. It's not part of labor expense, so we want to subtract that because your family needs to eat, so we don't want to consider that as available for debt service. So as a result of that math, we have 138,000 every year, roughly, in cash to cover our debt service. So what is our debt service? Our debt service is principal plus interest that we pay each year. So that's, in this example, 40,000 plus 32 in interest. So it's a total of $72,000. That's what my bank payments are each year. So we look at, just some quick math. We take the available funds divided by the debt service, and we come up with 191%. That's a pretty comfortable level. That means that we're in the green light, if we use the traffic light example here, of being over 150% in a term debt coverage ratio. If you're under 100%, that's a red light scenario, and that means that you're really struggling to make your debt payments, and you probably need to change something in your business. So this is something that you can, it's valuable just in and of itself as a number. You can compare how it trends over a number of years with your own business, and you can look at peers in your industry perhaps and see, how am I doing compared to others. Another one is liquidity. Your current ratio, that's how much money is available to pay your bills. This is a pretty simple one. It's your current assets divided by your current liabilities. So how much you own versus how much you owe in your business. In this example, it comes to 3.9, which is well above the green light ratio. In inventory heavy industries, such as nurseries, wineries, etc., your current ratio should be higher because you're including inventory in this current assets. And inventory is great, but it doesn't pay bills, not directly at least. You need to sell it first. So you want your current ratio to be higher. Along those lines, there's another liquidity ratio called your quick ratio. And this is how much money is immediately available to pay your bills. So it's current assets minus inventory divided by current liabilities, and that's what they call your quick ratio. So you're taking inventory out of the equation and just looking at basically cash compared to what you currently owe. In general, over 1 is best. If you're significantly below 1, that means that you're relying on selling your existing inventory to pay your current bills. And that's okay, but that can be an uncomfortable position if your sales stumble. That means you're very reliant on your sales every month to pay that month's bills. Available funds to gross revenue. This is another one. This is basically what is your working capital almost? What is your liquid assets relative to your gross revenue? So current assets minus inventory. So the same factor from your quick ratio, plus any available lines of credit. If you have a seasonal line of credit available or something like that, or unused loan availability, add that. So that's basically what's available for you to spend, and then divide that by your gross revenue per year. It's not going to be, it's going to be a figure less than 1. So in this case, we have $55,000 that this business has in liquid assets, plus they have a line of credit of 150 available to them. And we're going to divide that against their annual gross revenue of almost $1 million. And that gives us a figure of 21%. So in general, you want to have a third or more of available funds to gross revenue. That's puts you in a comfortable position. That means that you're not struggling to pay your daily bills. If you get below 20, it can be concerning, especially if you're in a seasonal business. And the reason for that is that if you're, say, a vegetable grower, I keep coming back to that example, but it's a good one. You're not going to have a lot of revenue probably until May, maybe later. And you're going to have a lot of expenses in March when you plant everything, depending on your operation. So you're going to rely on your cash reserves and your line of credit, perhaps, to get you through those spring months. So you want to consider your liquidity. Another one is debt to equity ratio. It's the inverse of net worth percentage. And it doesn't matter whether you do one or the other, but you should do one. And that means basically how much debt does your business have compared to how much you own. So you want to take your total debt to do the debt to equity ratio. You want to take your total debt to owner's equity. In this case, the farm is worth about $1 million. It owes in total debt to banks and trade partners through accounts payable about 400,000. So the debt to equity is a little more than a third, and that's pretty good. That's not quite in the green light, but that's comfortable. It's the inverse of net worth percentage. If you flip the ratio, it would be basically 2/3 is the net worth. If you go below 50% of net worth or above 50% in your debt to equity, that means that your creditors own more of your business than you do. And when your creditors own more of your business, own more of your stuff than you do yourself, who's driving the bus at that point? You're working for the creditors more than you're working for yourself. So that's something to consider. It's not necessarily terrible to be highly leveraged, to be over 50% in terms of debt to equity, but something to consider. And you get into a red light if you're above 70%. That means you really have very little equity in your own operation. Profit measures. Return on assets measures your profits relative to your total assets. So in this case, to calculate it, we're going to look at our net farm income. We're going to add back interest, because interest is really sort of a return on an investment. It's to the bank, not to you, but it's a return. And we're going to subtract our own draw, because in this case, it comes out of profits. So our net for our return on assets is $78,000 per year. Then we're going to divide that by our total assets. To do it right, you'd want to do your average total assets, so what they are at the beginning and the end of the year, and then average the two. But for simplicity's sake, you could just take your year-ending assets. In this case, that gives us 5.3%, which is a green light. So that means the business earning the profit that the business is earning equals about 5% of the total money invested in the business, and that makes for not a bad investment. If you were getting 5.3% on a bank account, you'd be thrilled. So getting 5.3% on a business is, not so bad. If it's under 1%, empirically, that money might be better off invested in a money market account or something like that than it is invested in the business. That means your business is not really performing. So, again, it may, you may have non-financial goals, you may have lifestyle goals. That doesn't mean it's not worth having your business, but ideally, you should be getting a competitive return for your business. Return on equity drills down into it a little more and measures the profits relative to what you yourself own in the business. So in this case, we don't factor in interest, because that's going to the bank, not to you. So we look at farm income less owner draw. So what's basically the net income after you pay yourself? In this case, it's 46,000. Divide that by the owner equity in the business. So the owner equity in this particular business is about $1 million. So that puts the return on equity at 4.3%. There's not really a traffic light for this, but it should be positive or you're losing equity. And you can compare the ROE, return on equity of your farm to what you might earn if you invested that equity elsewhere. Ultimately, you could take that money and put it into something else, another enterprise or another investment. And, it's worth sometimes considering that if you're, um, if you're not driven by non-financial goals, if you're just looking at, return, you want to have a competitive return for what your investment is. Net profit margin is another one. That's basically your net income divided by your gross revenue. In this example, it's 4.9%. Some feel that should be above 10% at a minimum and ideally above 20%. There's no rule for this. There's no green light, red light, but it should be positive. So that's one factor. Operating efficiency, which is your expense to revenue ratio. That basically shows how efficiently a business is producing its core products. So you take total expenses, take out interest, take out depreciation to get a net expense a net expense level or net expense number divided by gross revenue. That gives your expense ratio. What that tells you is basically of the money that comes in the door, how much is being directly spent on expenses. In this example, it's 80%. So this is actually in the red for this particular farm's example. I used an actual farm for this figure because I wanted to give real examples. So this farm is spending of every dollar that comes in the door, 81% goes right back out in terms of expenses, and only 20% goes to support the business, essentially support reinvestment or expansion. Ideally, that would be under 65% if the business was more efficient. Again, there's not really a number you have to hit here, but in general, the lower the percentage of your expenses, the better. Another one is asset turnover. That measures the amount of sales that you're generating for every dollar invested in the business. So in this case, we have an asset turnover ratio of 0.64 or 64%. Some feel that this should be at least 60%. What that means basically is how hard is your money working for you that you have invested in the business. So this farm has about $1.5 million invested in assets, probably a lot of it in land. And so how much revenue is that investment producing? Asset intensive businesses, of which agriculture is one, typically have a lower asset turnover ratio. If you had say a software company operating out of a rented location, don't have a lot of assets, but generate revenue, your asset turnover ratio may be really, really high. And that's fine. So this is industry specific. In agriculture, businesses need stuff. They need land, they need equipment. So it's asset intensive. So the asset turnover ratio is going to be lower. But it's a good number to compare from year to year or against yourself to see how hard that investment is working. I know I'm a little bit over, but I'm almost done. So we'll just wrap it up here. So again, you want to compare apples to apples, compare to yourself, same time of year measures. If you're, again, going back to that vegetable grower example, you don't want to compare your balance sheet in April 1st as it would be in August, after your most expensive month versus your highest revenue period. You want to look at the same time of year. You want to be consistent in how you're accounting for, again, those three big line items: inventory, assets, and depreciation, and owner draw. I should have put that there, but that's a key one too. So you want apples to apples for your, comparing against yourself or against others. So, what to do next after all this? You don't need to make it complicated. Just strive for continuous improvement, strive to do a little bit better every year. Pick a few things to work on each year. Look at your, benchmark yourself and look at where some of the biggest discrepancies are. Where's my biggest bang for the buck? Where's my biggest room for improvement? Ask where am I doing well, try to continue that, and where can I do better? For those diverse businesses, enterprising can be useful. Strive to do that if you have a really diverse business that's where all your expenses are commingled. Labor can be a really tough one to divide between enterprises. If you're that proverbial agritourism business where you have the pick your own and the growing operation and the retail operation, and you're doing a lot of different things with the same staff. Trying to figure out where your staff really spend their time can be important. So you expense that time against the appropriate enterprise. And ultimately, the most important benchmark is against yourself. External benchmarks can be really important and tell you a lot. But I think that introspection, that self-examination can be really important too. So with that, I see I'm almost at the top of the hour, but we can go, with your indulgence, we can go a few minutes over. I will take any questions that came in. My email is up on the screen. If you think of something after, feel free to email me, or if you want me to send you the slides or the links that I gave, or more information on Farm Credit East benchmarks, I can give you that. Mackenzie, do we have any questions?
So there is not a question, but there's a comment.
Okay.
So it says, thanks for mentioning CISA's vegetable benchmarking project. I'm working on that project, and I just wanted to confirm that we'd love to work with any additional diversified vegetable farmers in Massachusetts or surrounding states who would like to take part and have access to the vegetable benchmark data that we've been collecting. Also,
Great.
I was wondering if you could talk a bit more about the kinds of Farm Credit East benchmarks that are available for mixed vegetables, for greenhouse, tree, fruit, and other enterprises listed together on the same slide. Also, I'm wondering how the next generation of benchmarks being worked on now for these industries will compare to the pre-2017 benchmarks.
Sure.
That was
So
a long-winded question. Sorry.
yeah, no, that's fine. That's actually some really good comments. So to CISA, happy to mention it. I think it's what you're doing is great, and hopefully you maybe get some more participants through this. Regarding Farm Credit East benchmarks, over the years we've had different our benchmark programs have evolved. One of the challenges with doing benchmarks, and this may sound like a complaint, but it's kind of the truth, is that a lot of people don't like to give their data to benchmarks, but a lot of people want the information from them. So it's either they're not in a position to give the data because their own records aren't adequate, or they're just uncomfortable sharing their financials or whatever. So it's always harder to collect the data, and then everyone wants it when you get it. So we've struggled a little bit with this at Farm Credit East. We don't automatically collect and use data from our customers. Our customers have to, we have privacy regulations and restrictions. So we can't just, take whatever farmers give us for loan servicing and plug it into a benchmark. Customers, we have to get specific permission from them to use their data. And sometimes we need more information than what a loan servicing requirement might be. We've struggled at times with the sample sizes and trying to get, apples to apples people in benchmarks and try to, classify them appropriately. So it's been a bit of a challenge over the years. So we have, for most of the industries that I list here on the screen, we have detailed income and expense line item benchmarks for most of them for, I think, up through 2017. At that point, we then switched to doing some, because our sample sizes weren't really statistically, in my opinion, statistically viable anymore. They were getting a little bit low, and we didn't want to skew them through, if we had outliers in the benchmarks. So we kind of switched to doing some basic financial ratios over time, looking at some of those red light, green light things that I went through in this presentation. So we did that for a few years, and now we're kind of at an inflection point where we're considering we think that benchmarks are important. We want to have them. We want to offer them. But we're not sure how they're going to look going forward. So we're kind of in a inflection point, and we're doing some introspection and self-examination of what we're going to do from here on out. But to give a short answer, basically, what we do have is available for free. If you email me, I can send it to you for whatever industry you're interested in. I can send you the line item income and expense benchmarks that we do have, and I can send you the ratio-based benchmarks that we have more recently. We have one that's set up as a spreadsheet where you can plug your own into it, and it'll give you a chart over time of how your farm compares to the benchmark farms. And you can see, on my graph, is my line higher or lower than what the benchmark is? Am I doing better or worse? And how did it trend? So I'd be happy to send those to anyone that emails me. So I guess that's the best answer I can give. Do we have any other questions, Mackenzie?
I do not see any more in the chat, but if anybody wants to ask their question, feel free to unmute.
Okay.
Give a few
I'll give some
minutes.
final thoughts. We can wait a few minutes for any questions, but
Sure. Yeah, that
I'll
sounds
give some
good.
kind of wrap up comments. I know I presented a ton of information here. Again, feel free to email me for the slide deck, or Mackenzie for the slide deck. I've given it to her as well, and it may be posted. The recording's going to be posted. So, if you want to go through some of these ratios for yourself, you may want to view it a second time. But so I know I presented a lot of complex information here, but don't let the complexity overwhelm you. Doing anything is better than doing nothing. Starting simple can be a good way to do it. And again, like I said, half of the value fully, I believe, is that beginning the benchmark process kind of forces you to get your own financials, in shape, your own financial statements and record keeping. I know that almost no one goes into farming because they love the paperwork. That's not usually the top attraction, but paperwork is part of the deal. It's important to have good records, both for your finances and for your operations. And ultimately, managing your business from records can bring you more success. So, my advice, I guess, is to start the process and do what you can, and don't feel it needs to be perfect or nothing. As I said, doing it even a little bit is a step forward. So Mackenzie, if we don't have any more questions, I guess we can sign off. But my email's up there, so feel free to follow up if if you had questions, or something you didn't want to broadcast publicly, you want to ask. That's fine.
Yeah, thanks, Chris. Yeah, there was no more questions in the chat. But if you did see in the chat, I did post my email address in there, and you do have Chris's on the screen. But I also posted the link of where this recording, as well as the slide deck, will be posted afterwards. But like we said, reach out to Chris or myself with questions, or if you want the slides, of course, we will be happy to share that with everyone. So with that, I think we're all set.
Mackenzie, if I could chime in too, this is Joe Benetti again from Yukon Extension. I'd want to also thank Chris Law for doing a great presentation today. Chris, a lot of great information, very helpful information. And I'd like to thank everyone for logging on today, and hopefully you found it helpful, interesting. And again, another thank you to Mackenzie for handling all the the technology part of the program as well too. It's much appreciated. So have a great day, everybody, and good luck with the season. Hopefully our weather will be kind to us this year, and hope you're all well as well too for the rest of the season. So take care and thank you.